What's going on, everybody? Welcome to the Wealth Webinar, where we teach you how to take back control of your money. And we do that by teaching you how to be the bank. But today is a special episode. Craig and I are going to do something that, I've wanted to do for a long time. Although we teach you how to take back control of your money, teach you the infinite banking concepts, and teach you how to be the bank, believe it or not, there are a lot of people out there that call us scammers, that say that what we teach doesn't work, that ask the questions about, like, why would anyone do this, and listen to these fraudsters. I've heard it all. And today we're going to expose it, because why not? On YouTube, I'm almost at 100,000 subscribers, and I found the more subscribers I get, the more haters I get. I guess it's kind of a love-hate thing. I actually made shirts that said haters need hugs. So today, what we're going to do, we are going to look at a couple of those comments, those haters' comments on our posts that are literally saying simple things. And I'm just going to read it, and we'll show it to you in a second. But let's see. How do you break through? You have to show them the math and the comparisons. I've created blah, blah, blah. This one, this guy says, what kind of math are you using where it makes financial sense to waste, keyword, waste money by paying fees, commissions, and higher interest rates? It must be unusual math. Well, this thread went on and on and on, and this is just one of many. But today, we're literally going to address this person, who we'll call Thomas, on YouTube. We're going to address his question, his thought, his, skepticism on what we do. We're just going to show you the math. We're going to break it down. But, I got to open with a quote that I often say. Will Rogers said this. He said, the biggest problem in America is not what people don't know. Will Rogers said, the biggest problem is what people like Thomas think they know that just ain't so. But let's unpack that for a second, because the quote is more than clever. It's actually foundational if you really think about it. You got people like Thomas and all the other haters out there. I mean, in their mind, they've been taught money works a certain way. And you know what? They're sticking to the prerogative. No, no, no. I'm going to do everything the way I've been taught. Take the money I earn, put it in the bank, take the money from the bank, invest that money in S&P 500, whatever, and then do what they've been told. I'm going to pay my bills, and I'm going to save whatever's left. And then I'm going to save myself to wealth. I'm a saver. I'm going to get wealthy. Yeah. And I'm going to pay my debts down the regular way. I'm going to do it my way or the highway. All these things. You might think they work, and I get it. Why would you think that way? It's because what you've been taught your whole life. That's what you're basing your opinions on. It's what you've been taught. It's what advisors have taught you. It's what mentors may have taught you. It's what your parents have taught you. Listen, I'm here today to literally set this whole thing straight and tell you that what you've been taught about money is, for the most part, false. I know that's a hard, big thing to digest, but it is. It's pretty much false. And the biggest challenge we face is not ignorance. It isn't ignorance at all. We're all seeking the truth. The biggest thing is confidence. Not just confidence in ourselves, but confidence in the wrong information. That's honestly one of the biggest things. Like, come on. What were you all told? Take the money you earn at work, and you should put money in a 401k. I'm not saying that's bad, but is that the best thing for every single person out there? Is that the best way to save for retirement for all of you? Is that what you should be doing with a large portion of the amount you save? These are all questions you should challenge. You should debate these. You should really think these through, but people don't. They're just like, oh, well, that's what I was told to do. Put money in the bank, borrow money from the bank, put money in the 401k, invest in whatever they tell me to invest in. That's it. It's just a paper loss, right? Yeah. All right. We see people all the time trying to disprove the math. That's what we see. We see it almost on a daily basis. People will look at our stuff, they will watch our videos, and they will try to somehow, some way disprove the math. I got some truth for you here. Math doesn't lie. You can articulate math differently and maybe perceive it the wrong way, but math, in its core, in its foundational state, does not lie. Everything that Craig and I have done, everything that we've done as a company, and what Craig really pioneered in this industry is literally, don't accept this as a concept that works for everybody. Don't accept this just because someone tells you this is something good. Don't accept this to be the fact. Let's prove everything with math. Let me give you an example. If someone said to you, hey, I can show you how to pay all your debts off in a fraction of the time without working harder, longer, or taking on any risk. Some would just be like, oh, wow, that Chris guy just said so. That must be the truth. Others would say, I like that. Paying off debt in a third or a fraction of the time without working harder, without working longer, and without taking on any risk. Prove it. Show me the math. Now that's a different way to look at it, right? Because now everybody's like, oh, yeah, show me the math, right? That's what people think. That's what they want, but they didn't come up with that question. Or, hey, who here wants to learn how to get all the money back for every single car you'll ever buy, drive, and own? Sound like a fast-talking scammer, don't I?
Oh, that must be an MLM. Oh, yeah, blah, blah, blah.
Some people are like, oh, wow, I don't know about all of you, but that does sound pretty cool. Get the money back for every car I buy, drive, and own? Yeah. And then other people would be like, I do like that. How does that work? And can you show me the mathematics that proves that that works for each and every single person that uses this? Not just some, not just the 1%, everyone. You see, when you start asking the difficult questions and you start doing your own due diligence and start questioning almost everything, then you start to get really close to the truth. And that's exactly what we're going to do. We're not going to defend IBC today. We are not here to defend whether IBC works, whether IBC will work for you. We are here to demonstrate that it will work for you. That's exactly what we're going to do. And we're going to literally myth bust this sucker, right? Yeah, all saw that program Mythbusters. Well, we're going to do that. And we're going to bust the mindset problems that we have, which I mentioned earlier, is the problem isn't what you don't know, it's what you think you know that just ain't so. That's the myth. And we're going to build a foundation, and that's exactly what Craig's going to walk you through. The numbers, the numbers, the numbers. And we're going to break down real life logic, like real examples, not made up ones, not ones that are, you know, it's funny. Actually, let me pause that and let me kind of transition. This week, 2 days ago, I had the opportunity to do a webinar for a brand new group that I'd never done a webinar for. And they posed me with a unique challenge. They said, Chris, we want you to come on for an hour and a half. And I'm like, perfect. That's the amount of time I love. And what we want you to do is we want you to show the infinite banking concept, but we want you to show how to use tax-free dollars to solve the long-term care problem. I'm like, ooh, well, that's an interesting one. I've never done that. But I got into it. And as I'm talking to people and as I'm going through all these things, we had a bunch of IUL folks on that webinar, and they're like, oh, are you talking about IULs? I'm like, no, for the 15th time today on this webinar, I'm not talking about IULs. Maybe you should watch the Kyle Busch scandal thing that's going on with IULs to learn a little bit. But nonetheless, I kept having to go through this. And what I found myself doing on that training is going through and repeating myself a lot. I even stopped at one point and I said, listen, I know some of you are listening to me and you're like, he already said that like 3 times. And I said, I know I said that 3 times. But you see, sometimes people need to hear things more than one time. And then after they hear things, I have to prove them. So what I did is I pulled the numbers up and I said, there's your proof. Well, that's kind of what we're going to do today, but we're going to do it very uniquely. And, you know, Shauna did something that I thought was really unique. She gave me this thing here, and I want to just read this. She said, every dollar you have has 3 options. And I thought this was really cool. Number 1, with your dollars you have, you can spend them. It's kind of fun, right? You can spend them until they're all gone. Number 2, you can save them. But if you save and the money's just sitting still, is it really benefiting you a lot, or is it just making you feel good inside? Number 3, this one you've probably never thought about. You can recycle your money. What does that mean? Well, you can put it back to work over and over and over again. You can recycle it. It's kind of like when you got a cardboard box or a milk jug, you put it in the recycle bin, you have to, in your mind, believe that that's going to become another box, and then another box, and another box, and another gallon of milk, and another gallon of milk. That same cardboard gets to relive itself and repeat itself over and over again. That's recycling. And fourth thing that you can do with your money, or fourth way your dollars can earn, this is one of my favorite, is you can just recapture it. You can recapture it, which basically means you can reclaim what's leaving your life. Now let's just discuss those. This is key. This is foundational. Recapture the money that's leaving your family forever. And how would you do that? Well, we would start with the money that's leaving your family, which is interest. principal payments you make to somebody else, opportunity costs, which is when you spend cash to buy something and you have this thing, but that thing is depreciating, but the money that you use to buy it is gone forever. That is an opportunity cost loss because that money can't earn for you ever again. Recycling is such a cool thing. Your money gets to perpetually be in motion. It's like, think of a flywheel, right? In modern mechanics, flywheels are a pretty cool thing. Once they get going, don't they just keep going? Right? Some people like snowballs. You roll it and it starts getting bigger and bigger, right? That's compounding. But a flywheel is a really cool visual that you can use when you're thinking of recycling. Recapturing is literally just like you're reclaiming value that you once had, value that you gave away. And that's normally money that just people lose. They don't think anything of it. I have said this, and Brent has said this, and we've all said this. The fastest way to build wealth is through your own debts and expenses. When I say that to a group, especially here in Buffalo, they're like, well,
That guy's an idiot. Why are we here? What are we listening to? Did he really just say we could build wealth through our own debts and expenses?
how stupid is that? Stupid is as stupid does, right? It's not what you don't know. It's what you think you know that just ain't so. The fastest way to build wealth truly is through your own debts and expenses because you get to recapture it. Once you learn how to recapture it, that money becomes yours to use, yours to put to work, yours to create a flywheel. Now that is incredibly powerful. And listen, folks, all this stuff I mentioned doesn't involve a product. These are foundational things. All these things I just said don't involve a product at all. Are we going to use a product today? Yeah, because we're going to make it a little more efficient. And the one thing we're going to use a product for, and I'm not going to tell you what it is. Some of you know what it is, but let me just ask you this. If there was a product that you could put money through, notice how I say not put money in, put money through, okay? You just put it in and take it out. Put it in and take it out. If you had a place where you could put money through, but yet your money, all of it that you put through it, continues to earn interest and dividends on a compounding basis, would that not be something worthy of looking at? And then if I said that thing that you're going to put money through allows that compounding money to grow in a tax-free environment, now I got just about everybody's attention. If I just stopped there, everybody would be lining up outside this door wanting that thing. And then if I said, oh, that thing that you put your money through, that your money continues to earn unconditionally and uninterrupted, you get compounding on it. Now, what if all of that money was to earn a return, a dividend crediting rate of between 5.9 and 6.6%? Now do I have your attention? But see, then I got to give everybody then I got to go one step further. And this is where the train comes off the rails, if you will. Everybody's like, oh my God, yeah, I want that. What is that? How do I get one of those? Who do I call? Hold on. One person in that group doesn't say, who do I call? They say, well, what is this thing? That was me. That was me a long time ago when I had those same thing happen when Mike at Cheesecake Factory was telling me the whole story. And I remember I just said, so Mike, what is it? And he said, you should know what this is. And all of you should know what this is. And some of you do know what this is. It's a specially designed whole life insurance policy from a mutually owned company that pays dividends. Oh, I don't want one of those. Nope. I'm sorry. You had me up to that point. I don't want one of those. But wait a second. You just said you wanted all those things. Oh, I did. I wanted them until you told me what it was. I don't want that. Well, why don't you want that? Oh, I heard that they're high commission and the only one making any money is the insurance company. And there's all cost, fees, cost, fees. I don't want one of those. But you don't want it, even if it's going to give you the uninterrupted compounding interest on every dollar, allow you to use that money, recycle that money, recapture that money. It's going to do it in a tax-free environment, protected from judgments and liens in most states. It's going to do it at a dividend crediting rate of between 5.9 and 6.6%. And then, like, you said you wanted all those, but now I told you what that thing is, and now you don't want it. Yeah, I don't want that. Here's your sign. And the sign simply says, I'm stupid. And then the person next to that person says, I'm with stupid. So you see, all you need to do in life is you just need to learn, and this is what I've gotten good at, is learn the people that you can help and the people you can't. And the people you can't, you kindly just say, here's your sign. And then you both put your sign in. Yours says, I'm with stupid with an arrow to the left or right? And that person that just said, I don't want one of those, you just says, I'm stupid. Makes sense, right? This stuff just gets fun. I look at a whole life insurance policy as a warehouse that allows me to do both recycle and recapture all of the money. It allows me to do all of those things. But you see, I just stopped calling it a whole life insurance policy, but we do have compliance. We have a compliance officer who, if I don't always say what it is and exactly give all the specifics, the compliance stuff, then I get in trouble by him. But here's what I like to call it. I don't like calling it a whole life policy because I know everybody hears that and I don't want one of those. So here's what I like calling it. I got my own private bank. That's right. I created my own private banking system. My own private banking system pays me guaranteed interest plus dividends. Right now I'm getting about 5.9 to 6.6% gross on my money. It's growing tax-free. I never have to pay the government on any of the interest that I earn. Man, that's legal. I'm not cutting any corners. I'm not doing anything. You can look up the IRS code. It's right there. My money's also protected against judgments and liens. So if you slip and fall out front here because we forgot to salt the sidewalks, well, then you can sue all you want, but you can't get any of this money because it's protected, even in this state, New York. That's right. Oh, and by the way, if I die tomorrow because I slip and fall and hit my head, my family's going to be in a way better place. That's what my private bank does. What does your bank do? Huh? It starts to sound really interesting. But as soon as you tell somebody what it is, they all of a sudden don't want to talk about it anymore. So all I do every day, all Craig does every day, all my entire team does every day is we go out in the pasture, out in the field, and we plant seeds. Every day, plant seeds. Yep. And then we tend to those seeds every week with 6 webinars, with 1 YouTube video every single day. We just keep planting seeds and then we just keep fertilizing that soil. We keep putting water on it. We keep tending to it, making sure the weeds are picked. That's all we do every single day. And it has worked out quite well. The harvest is quite good. But you know what? The problem is every day we got to keep doing the same thing. We got to keep picking the weeds out. The weeds are the haters, right? The weeds are the naysayers. We got to pick them out of the pasture. We got to go put water on those seeds that we planted every day. We got to keep letting them know, hey, we're here. Here's some water. We want you to grow. We got to have the sun coming out, okay? So we got to keep nurturing our pasture, our field. But that's just what we do every day, consistently and persistently. I'm almost talking in parables here, but like this is exactly the truth. You want to build wealth? Plant seeds every day. Nurture those seeds, water those seeds. It doesn't matter what you plant. Whatever you plant will grow, but you got to weed it. And that's what we're doing today. We're going to weed it. We're going to show Thomas the weed why he doesn't belong in our pasture. And that's okay. And I'll send him a sign if he wants one. Heck, I'm going to send him a sign anyway. Just going to keep planting the seeds. How many dollars in your life do you want to come in? How many? The word should be an infinite number. I know we got to kind of, in real world, we got to have a dollar amount that we're shooting for. Mine's 350 million. What's yours? I just like big numbers. That's a number I've had in my head now for 4 years. I put it into the universe every single week, sometimes multiple times a week. I have to stare at it every time I turn on privatemoneyclub.com because it's right there. 350 million. You see, I'm training my brain, my mind. I'm planting the seed every day. You should be doing the same thing. Same thing. How many dollars in your life do you want? That's it. Where are they going to come from? I'm going to draw this. I like to think of money, and somebody showed me this a long time ago, and I thought this was brilliant. Do you realize that money is everywhere? There is no scarcity. There's no shortage of money. None at all. All of you can have as much as you want. There is no limited finite amount. I know Bitcoin, there's a finite amount, but money effectively in the real world today, there is an infinite amount of money. So think of money like a big raging river, okay? This is my big raging river. And I'll put some, in here, you got some rocks. I'm not gonna do my best Bob Ross painting here today, but let's just kind of try. We're gonna do this. We're gonna put some color here. The water's flowing, it's fast, it's moving. Got some like little things, hold on. Bob Ross, you always gotta have a tree, right? And how does Bob do a tree? He's like, I got this thing over here and blah, blah, blah. And then that thing becomes a tree. I have no idea how he does what he does, but somehow like that thing becomes a big tree and he's got another tree over here. Got trees everywhere and bushes, but this is the river. Sorry, I got a little carried away. For some reason, Bob Ross has been somebody I've always liked. You know what? This is money. Think of this raging river just like you would money because there's an infinite amount and it's just kind of flowing by you every day. It's just flowing by you every day. And you're just sitting on the sideline. You're sitting on the shore and you're just watching that money flow. And then sometimes, there's a big surge of water. The water comes up a little higher and you step back because it kind of comes over the rocks where you were. And other times it's a little lower. Depends on the season. Winter season, the fall season, the spring, the summer. The water levels are always different. The flow is always different depending on the season and the cycles. But see here, none of that matters. Because here's what you got to do. You are sitting on the sideline. You're sitting on the shore watching all of this happen. All of this is all the money that's passing you. All of this is all the money that's flowing by you. There's other people. There's a big bear over here. Let's draw a bear here. Let's see, bear. Here's my bear. He's got a little tail, feet, big teeth. Anyway, I'm a much better drawer, but that's my bear. This bear's over here swatting salmon out of the water. He's just swatting them out of the water, and you're sitting there watching. Oh, look at the cute little bear. And you're watching the little birds fly around. You're just still on the sidelines. You're just taking it all in. This bear is getting some. Yep, that bear is in the water. That bear is getting soaking wet. And that water's freaking freezing. But you're still watching it. Stop sitting on the sidelines. Stop watching money flow by you. Move your ass from the sideline. Get in the water. Oh, I know, it's freezing cold when you first get in. You're going to be really unhappy. It's not going to feel good, but you're now in the water. So you know what you're doing now? You're disrupting the water. Let me just show you what that looks like. You're disrupting the water that's streaming down. You can feel the pressure is hitting your back, and now it's got to go around you. But what you do is you reach your little palm out, and you kind of make a palm, and you catch some water, and now some of the water's in your hand. So now you disrupted the flow of that. And now you got a little disruption in your hand, and that money, that water, it's yours now. It's not going by you. And you realize that, and you're like, oh my gosh. Then you get yourself a bucket, and you're like, all right, I'm going to fill this bucket. And then you just keep going over to the side, and you just keep setting that bucket over here and another bucket. And then you're like, well, I need bigger buckets. And then you do barrels. You're like, shit, I'm just going to start doing barrels. And then you figure out how to create this little thing, this little paddle wheel that just goes round and round like a flywheel. That little paddle thing, and all it does is got little buckets on it. And those buckets fill the big barrels up here. So you're not having to do this anymore. You created a flywheel. That flywheel's dumping water in your buckets, filling these buckets up. All you now need to do is now you just need to go over there and you need to get more barrels. You're just filling barrels up, barrels of money. And you're not even doing it because the flywheel, your money is working for you now. But now, all you were sick of doing is you're sick of replacing the barrels. You're like, man, I don't want to replace the barrels anymore. But you got such a machine going here. Your flywheel's turning. It's filling up bucket after barrel after barrel after bucket. And now you're just like, I'm going to go get somebody else to replace the barrels. All you did to make this whole thing happen, and I just came up with that all at once. Okay, I never did this before. All you had to do is get uncomfortable and get in the middle of that flowing water and disrupt it. And as soon as you disrupted it, you felt the power of it hitting your back, and you braced yourself. You kind of leaned back into it, and you got your comfortable place. You're like, all right, my legs are numb. I'm not cold anymore. And then all of a sudden you just feel that, and you're like, all right, I'm comfortable now. I got it. It's a little uncomfortable getting out here. That shock kind of, of men, that thing when you get in cold water up beyond your waist. Yeah, that's done now. And now you're just holding the water in your hand, and then you're grabbing it in a bucket, and every time you got to take it over the edge. You're like, this is work, but I like it. I'm disrupting it. You put your arms out in the water, and you get down to your chest, and now you really feel the water because now you're really disrupting the water. You got your arms out disrupting. You feel it. You feel that power, and you're like, wait a second. What if I created a thing that just moved this water off to the side and put it in buckets? And now I could literally just, that's mine. I harness this energy. I went deep into that. That was not part of the script. I just want you to understand how easy it is today, in today's economy, in today's world, to disrupt the flow because people are complacent. People want handouts. They're looking for Mandami and the government to hand them checks. They just want freebies. Not you. How many we got on here? 155. None of you would be here if you wanted a handout. You're not sitting back, sitting on the sideline, waiting for a check to come in from the government and then hoping that they're going to send another one, but not knowing if you're going to get it. No. All of you are diving in, jumping in that freezing cold water because now you're ready to disrupt. And that's what we're going to do today. We're going to disrupt. We're going to disrupt your mindset. We're going to disrupt Thomas's comments, and we're going to do it in a super powerful way by simply showing you how to recycle and recapture money in a different way than you've been taught. Craig, can I turn this over to you? I want you to show everybody a little bit about what we're talking about here. And I want to go through the two mindsets. I don't know if you want to do that or if you want me to do that, but let's just dive into this thing.
Yeah, we can dive into it. And I like your illustration of the water. And what I was thinking to myself is this Thomas fella and the people like him are looking at that diagram going, yeah, but Chris, why in the world would you spend the money to build that water wheel? That's a waste of money.
Yeah, that is Thomas. That is exactly what he's saying.
Yeah.
That's stupid. Why would you build a water wheel? That costs you money. You'll never get that money back.
Yep. And so a lot of times when we're
Craig, Thomas would be right. If all we did is built a water wheel and that was it, that'd be a dumb investment. That'd be a dumb place to put your money because, like, you know, if the water wheel doesn't have a purpose, if it isn't solving a problem, what good is it? So Thomas isn't exactly wrong. Thomas just doesn't understand. He thinks he knows, but he doesn't know. But you see, this person that's in the water figured out the water wheel serves a purpose of filling more barrels, and more barrels go out to build more water wheels. And as he builds more water wheels, they fill up more buckets. And as he just keeps doing that, he gets smarter and smarter and more efficient. And he's no longer giving money away. His money is earning money for him.
Right. Yep. All right. Well, should we jump into it? I've got a number of things I'll be jumping into. I've got slides and YouTube channels and the vault. So we're going to be bouncing around a little bit here. So I hope everyone's ready for the ride. While I'm getting that set up, Chris, I know you always like to ask the question of the audience who's here for the first time. So maybe we should do that while I'm getting this up. All right.
Because, you know, Thomas wants to read the disclaimer.
Yeah, Thomas can read the disclaimer. Of course, all the stuff we're going over, there's some variability to your specific situation, your policy structures, your HELOCs, but this is the disclaimer. I think everyone had to click on that when they came in anyway. But so one of the things we want to do, Chris, is on your YouTube channel, there's always all sorts of fun comments. And I think you started reading some of this one, and I think this video was talking about how you can use HELOCs and policies and different tools to be more efficient in your pay down of your mortgage, your debts. And you know, some of these comments is, you know, just this Thomas fellow is asking, well, what kind of math are you using here? It makes no financial sense, you know, wasting money on the fees. So why would you spend all this money building that water wheel that you have filling up those water buckets? This is a real question. So at the bottom, this is what kind of kicked this whole thing off is he says, here's a challenge. Just show us the numbers. It's never been done before. We're not gonna hold our breath because we're sure you're never going to show us any numbers, but we want to show you the numbers, Thomas. We wish you're here with us, but we want to show you the numbers. So we're going to go over why it makes sense to pay down mortgages in a different way than maybe Thomas and some others are used to, which is you have a mortgage and you just keep throwing extra cash at it. Can you pay that mortgage off faster? Absolutely. Are there some pros and cons to doing that? Absolutely. So we're going to talk about those. And then there was another video, Chris, I think you had Christy on and you guys were talking about how to pay down some different mortgages. And it's just interesting to see these comments because, well, first off, this is dumb. And this person doesn't even need to watch the whole thing because they already know it's dumb. And really there's no
Not only is it dumb, it's a waste of time. It's dumb and it's a waste of time.
Yeah. So a HELOC isn't magical, and I don't think we've ever said HELOCs are magical. It's just it's a tool where we can reposition our money. And I think this is one of the big things that I want to highlight is if you prepay a mortgage, is there a way we can run money through a tool before we prepay that mortgage? Can you prepay a mortgage and make progress that way too? Yes, but there's more at play here. So a lot of times what we're talking about is, let's look at your whole situation. Let's look at all the pieces and parts you have. And is there a way we can move some parts and pieces around or reposition some of your money flow to be more efficient? Just like Chris said, the guy is in the middle of the river. He's grabbing as much water as he can in his bucket. But is there a way we could maybe get to the point where we build a water wheel? Can we use that water wheel to fill up the buckets?
I love the Sean one, man. Anyone can do a program that we haven't made clear, given you AI, you can't even type. Sounds like me typing. Haven't explained where the extra money comes from and use the rich dude as an example. If you were legit and not trying to jock, so we're jocking people around into a system You would have given simple, stupid examples. I don't know why you use simple and stupid in the same thing. Could have just said simple examples. Using real people example. Dave Ramsey is legit. You two are clowns with a whiteboard full of numbers. Look at me, I do math, I'm smart. Messing with people's lives is effed up. This video was pointless and some good pints to keep you watch or
Points. Yeah.
points, pints. I mean, I thought he was maybe talking about pints of Guinness or something. I don't know.
Well, hey, and at the end of
Hilarious.
the day, so Chris, do you see the YouTube channels here?
Yeah.
You know, if people want to go out there and look at this stuff, you know, here's the thing. If you're part of our community and you're seeing these things, I think what would be fun with these folks is just to say, hey, I've used this and you know, I've experienced a certain, you know, I just think we as a community can help kind of shut them down because the people that don't really know what's going on are also seeing these comments. You know, and here's someone saying HELOCs are not simple interest. And I just look through some of these and oh my gosh, so stupid. Math is math. Why do you pay more interest at the beginning of a mortgage? It's math. And so these people just don't really understand what's going on in the bigger system here. So there's one video. Here's the one with our buddy Thomas, you know, where he's asking us to do the challenge. You know, he's not going to hold his breath. So we're going to run through some of the math. And I'm not going to go through this one, but if you want to scroll down and see, this guy is talking about, you know, what do you do with piles of goat teeth, caveman Mike Ort? I mean, we get some entertaining things out there as well, but if you have some time, you want to go out and grab this YouTube channel and read that comment. Will's got full, just, this guy is full of fun here. Marius and I have had a good time reading that comment. So going back to our list of commentaries, one more I just want to go through is, you know, Allison Hunt is mentioning that HELOCs are not simple interest. And so we should think about that and determine, you know, is a HELOC really simple interest or is it not? That's really simple to, you know, it's really easy to combat because it is. HELOCs are indeed simple interest. And we're going to go through some of the math on what those mean. All right. Now, Chris, I just want to go through something real quick because at the end of the day, if you have a mortgage, can you take your extra money and put it into the mortgage? And will it pay it down faster?
I don't know.
Absolutely.
Show me the math.
Well, it will, but is there a downside to that? So here's I just want to go through these points and I just want to go through them. I know there's a lot of words on this slide, but I want to go through each one of them. So a traditional mortgage grows interest on a fixed schedule. You pay most of the interest up front and principal later. Is that true or false? I think that's true. You have more interest up at the beginning of the mortgage and then it kind of fades out and you get principal later. Now, is it true that every time you prepay your mortgage, you're just trapping more money in the walls of your house? Of course. Do you have that? Let's just ask the Thomas or anybody else out there. If you paid $5,000 over the past year into your mortgage and you wanted $2,000 back, can you just call the bank up and say, "Hey, can I have $2,000 back? I paid a little bit more on my mortgages this year. Can I just have some of that back?" What are they going to say to you, Chris?
No.
Yeah, they're going to say no. They'll probably laugh, and then they'll say no.
Yeah, probably laugh then say no.
And there's a quote, and I think it's by Mark Twain, and I don't know the exact, I should have looked it up, but he says something to the effect of a banker will lend you his umbrella when it's sunny out, but want it back when it's raining. And essentially that analogy or that quote is referring to if you need money from the banker, he's only going to give it to you when you don't really need it. But when you really need it, you're not going to be able to qualify to get it. So are there some other strategies where maybe we would have more control than just prepaying a mortgage? So we'll go over some of that. And then in this simple interest HELOC, one of the benefits of doing the simple interest HELOC is that every time you put a dollar in it, it's reducing the principal, which means you essentially reduce your interest cost and what you owe. So with all of that said, you know, we want to think about the HELOC is allowing us to run money through that line of credit, or whether we're using a policy, we're running money through, it's almost like a line of credit. And so we want to think about, can we use infinite banking and velocity banking together where we're really taking our flow of income, our expenses, and our debts and doing something better with it than just prepaying a mortgage. or just throwing more cash at our debts. So that's what we're going to cover today. Before I go on to the next piece, though, I do want to say this doesn't work for everybody. And as I was thinking through this, the Thomases of the world and the other folks, if you don't have a clear plan and you're not putting together a strategy with these different tools of policies, just like Chris said, that water wheel, you can build a water wheel, but if you don't know what you're doing with that water wheel, you're generating electricity, you're trying to fill up a bucket, then you're probably not going to be successful. So the first step is we want to have a plan and we want to follow it. You want to be able to track your cash flow and follow the process. And the big thing is we want to be able to recapture interest that otherwise would have been gone from our family forever. Now, who is this not for? If you're one of those people that think your HELOC or your policy loan money is just free money that you can go just go buy more garbage, yes, those aren't the people that are going to be using these types of tools that are going to be successful. So is this for everybody? No. Is it for people that want to do money in a different way? Absolutely. All right. So who remembers this movie? Show
Mhm.
me the math.
I love that movie.
Yeah, that was a good movie. That was a fun movie.
Funny, he doesn't look any different now than he did in that movie.
Yeah, there's something going on. I don't know. Maybe he's all AI, but yeah, he looks the same today as he did back then. And even when, gosh, for some reason I can't think of the movie, the airplane movie that he was
Top
in.
Top Gun?
Yep, Top Gun. There you go.
Oh,
Just
yeah,
couldn't pull it out. Yeah, he looked exactly the same. So
definitely.
anyway, we're going to show you the math. So let's do a use case because everybody likes use cases. Let's go through and some of these are loosely coupled on people I work with where we went through, did different scenarios using the vault and just talking through, should I do this? Should I do that?
So you're saying these aren't made up cases on just rich people?
These aren't made up cases just on rich people. These are from people I've talked to. Now, I'm not using the exact numbers. I'm using in the ballpark because I don't want, someone look at this going, hey, that's mine, and you shouldn't have said that. But let's just say Bucky Doe. Bucky Doe is buying this house or maybe they already have the house and their mortgage balance is $305,000. It's on a 30-year fixed at 3.25. And I'm not going to talk about the taxes and PMI and all that other stuff, but let's just talk about the principal and interest on that loan would be $1,327.38. They're just going to be paying that for the next 30 years. But we do know that most people either refinance or move within 7 years. So Bucky Doe and his family may end up getting a better, bigger and better house down the road. So they may refinance and restart this whole process over. A lot going on here, but I really want to talk about, is Bucky Doe's loan really 3.25%? And if you look at the loan, it's starting out at 305,000. Yeah, can everybody hear me? I'm seeing that there's a few audio issues. Yes. Okay, perfect. Looks like one person may have lost audio. All right, the loan amount at 305, 3.25 for 360 months, 30 years. We're going to have a payment of $1,327.38. Now, have you ever heard of what's called the volume of interest per payment? What we mean by that is of that 1327, that's my very first payment I'm making to my mortgage. $501 is going to principal, 826 is going to interest. Then doesn't that mean that 62% of my payment is going to interest? That's what we mean by the volume of interest. And if you take nothing else away from our conversation today, quit comparing interest rates. Start looking at the volume of interest on everything you're doing. Because if you look at your mortgage statement, there'll be something called total interest paid, the TIP, and it's going to show you what is the actual interest that you're going to pay.
Hey, Craig, is
So
there a way to make your screen bigger? Some people like me have very bad eyes and we can't see those little tiny numbers. Can that be any bigger?
I don't think, yeah, I don't. So this one is not able to, unfortunately.
Okay.
But the numbers are essentially we're taking the principal of 305,000, we're taking the total interest, which is 172,856. That means we're paying almost 56.67% in interest. So we're not really paying 3.25. I mean, that's banker's math. And so, yes, it is true that as each payment happens, we're going to be paying more on the principal side, less on the interest. But every time we get to about that 7-year mark, we're going to reset this, and the banker's going to say, Yay, because most of your payment now is going to interest, which they love. So this is really, really, really important to understand because I mean it's a lot of interest that we're paying out of pocket up front. Is there a better way to do this? So I'm going to jump into the vault here. We're going to run through some different examples here. And Chris, I don't know if you want to tell a quick story, but I gotta set this up real quick.
Yeah, I mean, there's always a good story. I mean, I had it here, like the two different mindsets, traditional thinkers, here's how most people think. They pay things off quickly, right? That's what they want to do. They see debt as dangerous. That's the Dave Ramsey thing. They avoid interest and shop interest rates as a continuous basis. They give up liquidity to do the things they do. They die with nothing owed. Okay, those are traditional thinkers. If you are coming in and you're an infinite banking thinker, you think like what we've been talking about: keep money in motion, use debt as leverage, own the interest, don't give it away, maintain access and control always, and live with everything owned, nothing owed. Does that make sense? So the truth is IBC isn't about beating the bank, it's about becoming the bank. And I think that's one of the big things. Most people are fighting to eliminate interest, but they're missing out on what the interest could have earned them. And I know that's a hard one to wrap your head around, but if they own the system, if you own the banking system, you want interest because it's interest earning interest for you. But if you're just plugged into the normal system, yeah, you're trying to eliminate interest because it's bad, because you're paying interest to someone else. When you become the bank, you pay interest to yourself and you keep all of it. That's what control means. So it's sort of a reality check. The financial system that you were taught was never, ever built to serve you. It was built to extract value from you. And if you don't believe me, like all the stuff right now about 50-year mortgages, you want to talk about how they plan to extract value from you? Like there is nothing that extracts value more than a 50-year mortgage. Infinite banking flips the script. It's not about tricks, but it's through control that you build wealth. All right. Not really a story,
All right.
but just.
Well, I appreciate you sharing that so I could have some time to get set up here. You try to do as much preparation and be ready to go, and then the rug gets pulled out from underneath you. That's show business, I guess. So here's what we have is a mortgage, just the exact same one we were talking about, $305,000 mortgage balance at 3.25. We're paying $1,327.38 a month in payments. I'm not including the taxes, escrow, or anything else. This is just the principal and interest. Now the question is, if we go down to the payoff strategy, this loan is going to take us 360 months or 30 years to pay off. We're going to be doing that for 1327.38 for 30 years, and our total interest cost is this 172,856. I'm going to make that a little bit bigger there. So this is just laying down the groundwork of, if you did nothing else other than just pay your mortgage, this is what life looks like. Okay, that's where we were coming up with about 56% of all your payments were interest to basically pay off that $305,000. Now with infinite banking, and let's just say that you happen to have $10,000 of sitting in a side account. And look, at the end of the day, you might, or you may have it, or you may not. And part of the comments were, hey, this is only for rich people. But I want to do an example of if you had a one-time dump of $10,000 that you could put in a policy. Now what we're going to say is, what if I took that $10,000 and I just threw it at my mortgage balance? And I happen to have an extra $1,000 and I want to throw that at my mortgage. How fast am I going to pay my house off? So let's take $1,000 extra a month and a one-time $10,000. So we're taking all this money and we're going to throw it at this mortgage. Everybody with me? Now, what's going to happen? We're throwing more money at the mortgage. So guess what? We're going to pay it off faster. 156 months. We're knocking the interest down from 172,856 down to $66,890. Now, Thomas and the other people out there, this is the math. Yeah, we threw extra money at the mortgage, and guess what? We got it done faster. There's really nothing earth-shattering here. It's just some simple math. The problem that we have right now is we've trapped this equity in our house, And let's say that you aren't in a financial position where you could get access to it through a HELOC or other means. Would you rather have an option to be able to access this money? Or would you rather be okay with it locked up at the bank and just not have any of this money available to you? So this is part of the decision of what we need to start thinking about and rewiring our mindsets, because at the end of the day, yeah, I can prepay my mortgage all day long and I'm putting more money into my walls and my rafters, but I don't have access to do anything with it. All right. So that's step one. That's what life looks like if we just throw cash at our home. Now, we teach the infinite banking concept process, which is using a whole life, a specially designed whole life policy to run money through that. So in Chris's diagram, we're talking about we're standing in the river now. We're seeing this money come into us through our paychecks. And all we're saying is we want to take some of that and put it in a bucket and get it working in this bucket for us before we go pay our mortgage or before we go do something else with it. So what would that look like if we were to create a policy with $10,000 dump in and $1,000 a month? The exact same money I was just talking about, right? I just took a $10,000 one-time dump into the mortgage, and I took $1,000 a month and added it to my mortgage payment. So Rhonda says, are we supposed to be looking at something? Chris, do you see my screen okay?
Yeah.
Okay. So Rhonda, yeah, there should be a screen share. So hopefully she sees it. But essentially what we're looking at is a specially designed whole life policy. And this is just the table of numbers of what does it look like year 1, year 2, year 3, year 4, and beyond. And essentially what we're planning to do here is initially put in $10,000 right away, and then every month put in $1,000 just to keep running money through this policy. Now, the beautiful thing about these policies when we set them up is you have guarantees and then you have the non-guaranteed side. And what this means in this particular company, it's been around since 1905 and they've never missed paying a dividend. But if they did missed paying those dividends, then we're going to be relying more on these guaranteed numbers. But because these companies that we work with, these mutually owned insurance companies, they've been paying dividends for well over 150, 200 years, we rely on these numbers in terms of cash value and what do we have access to. So right away, here's what the haters are going to say. I'm just going to anticipate. Who in the world would want to put $22,000 in this vehicle and only have 18,000 available? That sounds stupid. You're losing almost 15% of access to that money. Why would you do this? Well, there's no secret here, folks. There's a cost of insurance, and we're buying about $314 of death benefit. But why are we doing this? We're starting a long-term strategy. We're not talking about a, get rich overnight type of a scheme. We're talking about a methodology to put money into a vehicle that has guarantees, that has compounding, uninterrupted compounding while we leverage this money. And we haven't found a vehicle that works better than this long term. So we're going to give a little something up at the beginning to get something in the future. Now, by year 4, we're putting in $12,000 and the policy grows $12,371. We now are at our efficiency point where from this point on, for the rest of our lives, we will have more coming out of this thing than we put into it. That's just the basis of what we're building in terms of these policies. Now, the question is, can I use this? And Chris, could I use this policy to pay down my mortgage faster?
100%.
Does it make sense to do so? Well, let's run the numbers. Let's go back and check it out. So back in the vault, and hopefully, Chris, do you see the vault screen? I just want to make sure we're tracking here.
Yep.
So I already showed you putting in 1,000 a month towards the mortgage and 10,000. Now I'm just going to pop open this infinite banking panel. We have that policy that I just walked you through where we're doing a $10,000 dump, $1,000 a month. And what we're going to do is come over here and activate using the cash value as a boost to pay off our mortgage faster. Now, in the cash method, it was 156 months to pay off the mortgage, 160 with the policy. So we added, 4 months, and sometimes it's faster, sometimes it's slower. It just really depends on, the specific loan setup. So now the question would be, we used our policy to pay off the mortgage. So we no longer have a debt with the banker. we have moved that money into our system where we control it. So in 160 months, we're no longer making payments to the bank, but what we are going to do is take the money from one hand and put it in the other hand. This is still our system. We want to go through and take that $1,327 that we were paying to the bank and run that back into our policy. Our policy has a loan, so that's what we're doing is we're refilling that policy loan. And we're going to do that for 165 months. So it'll take us 325 months just to do this whole process. But what happens after this 160 months? Do we have to make a payment next month if we lose our job? Can we start filling this bucket up and then use the money again? Remember, when we did the cash only method, we were locking money up in our walls. Here, we still have access to the prepayments that we're making. Now, at the end of the deal, at the end of the 325 months, we have $385,000 of cash value built up and a death benefit over $500,000. Okay. We also went from an interest environment where we paid $172,000 to $69,000. So one of the things we have to think about is, are we willing to put this process in place to take control of those payments and build that up over time and have this money available to us longer term? Now, I know some people are going to be saying, well, wait a minute, Craig, there's more to the picture here. And there is more to the picture here, because if I had paid my house off at month 156, but yet I pay my house off with infinite banking at 160, and then it takes me another 165 months to pay off the policy loan. Well, wouldn't it be fair to say if I took that 1327 plus what I was putting into premiums, shouldn't I look at all of that? Shouldn't I say for the next, well, let me just pull up the slide because I've got them here. So I just had some quick math. If in 156 months we had our mortgage paid off, but with infinite banking it was 325, shouldn't we say for the next 169 months we're going to take the mortgage payment plus what we were putting in the policy? So we were now doing 250. So I would be able to squirrel away about $266,000 if I just did the cash only method, put the money in the house, and then just kept running that money into like a savings account. So here's what we have to decide, and I'm going to screen with this one. All right. So if we look at the cash method versus the IBC process, the mortgage is gone in 156 months with the cash method. With the IBC process, the infinite banking concept process, it's done in 160 months, but we're going to take another 165 months to pay the policy loan back. So what I'm going to say is, well, after this 156 months, keep making that same payment back into a savings account for 165 months. Where are we at month 325? 266 versus 385. Taxable account, non-taxable account. Where are we with death benefit? 0, 520. Who has control of this capital? Well, you've got your money in the bank, and while your money's locked up in the house too, you have loss of control of capital. Whereas in the policy, as we're filling it back up, we have full control of that capital. What about your liquidity? What about your legacy? And someone may come back and say, you know what, I don't care about legacy, I don't care about liquidity, I don't care about control of capital. I'm happy with the 266. Then great, the math proves that, go do that. But if you're like most of us here and me as well, I want to run my money through the policy because I want all of those things. I want the control of capital, I want the liquidity, I want the legacy. So those are how some of the numbers play out on the infinite banking on paying off the house versus a policy. So here's the so what. So it took 169 months longer, but what'd that buy you? Well, if we take that 169 months and we just keep putting at the cash method that money to the side, isn't it true that we turned about 266,000 of cash flow into over 382,000 of capital that we own and control, plus a $502,000 legacy value? So this is one of the things we're always looking at is, you can pick route A or you can pick route B. So here's the math. Chris, I don't know if you have anything you want to add on this one before I jump into the other examples.
I think I got it. I'm just answering questions over in the Q&A.
Okay. All right. So let's go to the second example. And so the first one was kind of using an infinite banking concept process using a whole life, especially designed whole life policy to pay off the house. Now, what if we used a second lien HELOC? There's also first lien HELOCs. There's all sorts of strategies, but I want to just try to keep this one simple and say you have a house appraised at 500,000, you have a mortgage at 305, and it's on a 30-year fixed at 3.25%. So your principal and interest is still this 1327. What would happen if we went out and got a second lien HELOC? The thing is, with the second lien HELOC, I'm going to make some assumptions. Your numbers could be different, but we have an equity in the home, let's say of 195,000. And so we may be able to go to a bank and get a second lien HELOC for 98,000. And I'm just going to use 7.75%. Now, Thomas and others may go, wow, Craig has really gone off the deep end here, because why in the world would you want to use a 7.75% second lien HELOC to pay off this 3.25 mortgage? That sounds like crazy business right here. Well, let's go through the math and check it out. So I'm going to jump back into the vault. I'm going to switch gears on our strategies here. So let's go to use case number 2. All right, so here we are. We're back with our mortgage at 305 and 3.25 with the 1327. We're now going to open up the Velocity Banking panel. Now, we're not going to get into all the details of how Velocity Banking works. If you want to learn more about that, Christy Van's out there teaching it. There's a lot of great material out there. Think of Velocity Banking as I have a line of credit, and in this case, I have a second lien HELOC. I have $8,350 of income. And what I'm going to do, instead of that income hitting my checking account and just sitting there while I wait to pay out bills, we're just going to reposition. So I'm not asking you to do anything, go out and make more money. But what we're saying is, can we take that money and just put it in a different place instead of our checking account? So that 8,350 is going to show up at our HELOC. And then what we're going to do is pay our bills out of that HELOC. So we have groceries, credit cards, we have gas, utility bills, whatever it is. We're going to pay that with our HELOC, or we're going to pay that with a credit card and then use the HELOC to pay the credit card off. There's lots of different ways to do it. So really, Velocity Banking is all about take your income, put it into this line of credit, pay down your expenses, pay off your debts, and at the end of the day, we're looking at your net cash flow. So the Thomases of the world would maybe say, well, why don't you just take that 2,360 and throw it at your mortgage? You could, but do you have 2,360 every month to throw at your mortgage? And then are you going to be leveraging too much? So here's what we're going to do. We're going to map all this out. So we're going to get all this mapped out so we know how much our cash flow is. Then we're going to use our second lien HELOC, which has a $98,000 available balance. And we're going to use the Velocity Banking tool to figure out what is my chunk size. So the whole idea of Velocity Banking is we have a line of credit, we're running our money through, paying our bills out, but then we're going to take chunks of money and throw it at the mortgage. And then we're going to fill it back up. And then we're going to take a chunk and throw it at our mortgage and then fill it back up. It's a very safe way to operate because we're taking chunks and then filling it back up, taking chunks, filling it back up. If you ever need to slow that chunk size down, great. If you need to speed it up, that's fine too. However, in the vault, we've come up with this revolutionary algorithm called the optimizer. And some may say, well, if I have 98,000 available in my HELOC, why not just take that full amount and throw it at the HELOC? Well, the tool is telling us our optimal chunk size is 6,553 because it's always looking at the interest cost in our HELOC versus the interest cost in our debts. And we're trying to balance those two things out all the time. It's really a cool algorithm. But if you think you're smarter than the tool, you can say, well, I want to use a bigger chunk size. Maybe I want to go up to 70,000. It says, well, in that case, you're going to introduce about $13,000 to $14,000 more of interest into the mix. I don't want to do that. So I'm going to go back to the 6,553. Okay. So let's go take a look at turning on Velocity Banking with our mortgage. So if we do nothing, it's 360. If we do nothing, we're paying 172,000 in interest. If we use Velocity Banking, remember, we're just simply repositioning where our money's flowing. The mortgage is gone in 92 months. We now have a chunk size that we're constantly throwing at the mortgage and then recapturing, so it's going to take us a little time to fill up our HELOC again. But we're done with our mortgage in 94 months. We reduced our interest cost from 172 to 43,000. And I'll tell you, I've done many of these scenarios. I've run the numbers and run the numbers and run the numbers. Velocity banking is going to be hands down the fastest way to get rid of your debts, but it takes the discipline of running that money through your HELOC, paying your bills out of it, and filling them back up. Now, realistically, maybe you have a bad month or two in here, or maybe several bad months. What if this goes up to 106? Who cares? I would rather pay 106 months on this mortgage and in my HELOC than 360. So now I want to go back and show you a couple things. Remember I talked about that optimal chunk size and how, here we are at 94 months with about 43,000 in interest. If you come back and say, well, I actually want to use 70 some thousand and I want to apply that towards my mortgage. So now I'm taking 70,000 out of my second lien HELOC and just throwing it at our mortgage. We just introduced some more time and we introduced a lot more interest cost. So this is where I'm saying, just follow the tool. Just follow the tool and what it's telling you to do. And down here, it's telling you that you're going to take 6,553 and add it to your existing payment and pay that towards your mortgage. Because we're starting off with such a high balance, I can do it again next month. So this is just going to tell you, based on your remaining balance, when should I take a chunk from my HELOC and pay off my house? Then this month I do nothing, this month I do nothing, this month I add it to my payment. And we're just going to keep operating that way until the mortgage is gone and then our HELOC is paid back. It's just simple as following the plan, right? So that's what a second lien HELOC would look like if we just use that to pay off the house. So I'm not sure what else Thomas and others want to see, but are there fees with the HELOC? Yeah, there might be some fees with the HELOC. Are there fees with credit cards? Do you have fees when you get an auto loan? Are there fees when you have a mortgage? Yeah, there's fees in everything we do. But net, we have to figure out, is the money that we have running through that system going to be more beneficial to us? Now, ideally, what I'd want to do is I'd want to have a velocity banking and an infinite banking policy all working on this debt together. And, we'd have to then say, all right, well, to be fair, to do something like that, let me switch out to another example here. So now, remember I had 2360 in cash flow. What I've done is I've said, well, I'm now going to reposition and take $1,000 out of my cash flow and run that in a policy. And then I'm also going to take $10,000 out of my HELOC and run that into a policy. So I've reduced my HELOC balance, available balance. I've also reduced my net cash flow, because what we're doing is we're taking some out of our velocity banking system and we're putting in our infinite banking system. So it's the exact same policy that I've already gone over that I showed you, where 10,000 dump in, 1,000 a month. Let's turn on the cash value boost and let's turn on our velocity banking boost. And this is what we call the debt blaster trifecta, because we're using infinite banking, velocity banking, and if you have multiple debts, a sequencing such as a snowball or an avalanche. Now, if you remember, it was about 92 to 94 months to pay off the house just using velocity banking. Typically, when you introduce infinite banking, it's going to slow things down a little bit. But you have to remember, in velocity banking, we didn't necessarily build any other assets or any other wealth. We just simply used debt tools to be more efficient, but we didn't build wealth. What we're saying with the policy, and this is really, really important, are you okay slowing down your debt process a little bit? So we're at 129 versus 94. But are you willing to do that and walk away with an asset with $150,000 of cash value and a death benefit of 290,000? We all have decisions to make. Are we willing to give a little something up to build an asset, to build wealth? Because look, at the end of the day, when our house is paid off, yes, we'll have a HELOC with access, with equity. We'll be able to use that. We'll have a policy that we own and control that has cash value that we can put to work. We can build more water wheels. In Chris's diagram, we can take more of our cash and build more water wheels to build more buckets. And this is where life gets really exciting, because now you can build a lot you can build wealth and just keep using this money and building wealth in a safe way. So at the end of the day, if you're willing to give up a little bit of time, you're going to build wealth and you're going to build assets that you can build more wealth with. So this is the trifecta approach with paying down debts, and this can apply to cars. This can apply to pretty much anything out there. All right, Chris, anything we need to go over? Because I'm going to switch to a couple more examples. I just didn't know if there's anything we need to address live or ask.
I think the only thing would be Kat had a message over in the Q&A. I apologize if I missed it. Can I run a hypothetical new policy start in the vault?
So in the vault, and I don't know, Kat, if this is what you're asking, but you'll notice up here that I have swap policies for sample data. And I think somebody else asked this question too, but we do have 4 sample policies in here. So if you want to get in there and just kind of play like, what would this look like with my debts if I had a policy that had a $10,000 dump in, 1,000 a month? Now, Kat, if there's something specific you want, that's where you work with our team, one of our money mentors. We can design a policy for you. You can load that up and play with it. But yes, we do have some samples for you to kind of play around with. All right. Okay, well, I'm going to jump over to the next example, and we'll do the cars. So Chris, let me ask you a question. I know we've gone through a lot of stuff, but if you're Thomas, do you feel like we're answering Thomas's question? If you're Thomas, let's play some devil's advocate. What else does Thomas want to know?
Yeah, I would think Thomas is getting his answer to the question. I don't know if Thomas is liking it though, because Thomas is going to come up with excuses as to why this isn't working, why this is a unicorn scenario. And he's probably going to start sitting there saying, well, that's just a mortgage. Let's see it on something else. That's what I got to believe.
Well, let's show it on 2 cars then. And so let's just say that Bucky Doe has a car. He owes about 25,743 at 6.48. And then his wife Goldie also has a car loan. And, so they're paying about $1,693 a month, about 54 $1,000 in car loans. So the question now is, could you use that specially designed policy? And oh, by the way, that policy, Chris, I forgot to mention, you know what the policy loan rate is on that?
What was it on that one? 5.95?
This one is 6.75.
Ooh, yeah, that's a stinger, right?
So can I use that policy loan at 6.75 and pay these cars off and be more efficient?
I don't know. I mean, Thomas would say, well, why would I ever pay off a car loan that's 6.48 with a loan that costs 6.75? You guys are idiots.
Well, let's look at it. So as is, and here's the situation. We want to deploy, say, a snowball or avalanche type of an approach on this. So when, let's say, Bucky Doe's car gets paid off first, what he should do is take that 798 and add it to the Goldie's car, and that's going to add some efficiency into his debt cycle. So instead of taking that 798 when Bucky's car is paid off and blowing it on stuff, take that debt payment and add it to Goldie's car and accelerate getting that paid off. So depending on which one pays off first, that's what you want to do. So that's why I'm showing in the snowball here. If you do that, you're going to pay these debts off a little bit, well, not necessarily faster in this case, but when you have credit cards and all these other things, we're typically looking at one of these strategies, snowball, avalanche, or cash flow index, just to figure out what's the most efficient order and what's the best way to pay those down. All right, so we have about 36 months if we do nothing and just keep paying those cars off the way we've always paid them off. Now what I'm going to do is I'm going to leverage my policy that I have, and maybe I've already had this. Maybe I've had it for a year. Maybe I've had it for 2 years. But what we're doing is we're taking the loan from the policy, paying off the cars, and then we're going to recapture back into the policy. So in 20 months, those cars will be paid off as opposed to 36 months. Now, this is where, guess what? If you miss a payment after that 20 months, who's coming to get your car? If you miss a car payment after that 20 months when they're paid off, who's coming to get your car? No one, right, Andrew? No one. If you miss a payment within that 20-month period, who's coming to get your car? Well, the bank's probably coming to get your car. So you have some exposure for that first 20 months, but after that, you've now moved those car debts into your system where you control it. You can, skip a payment, pay it faster, do whatever you want to. But we're not talking about a lot of different time difference here. It's 36 months versus 35. But at the end of that 35 months, because we've been using the policy and building it up and putting money into it, we not only save an interest, because otherwise we would have paid 5,200. Now we're paying 3,000. That money's going out to the car dealer and a little bit of interest going to the insurance company. But now we're sitting on an asset with 41,000 and a policy with a death benefit of 352. Now I could have taken that same money and thrown it at the car and paid it off faster, but then I'd be sitting there with lint in my pocket at the end of that debt cycle. Isn't it true that I could pay those cars off with cash? Absolutely. But then you're sitting there with nothing left in terms of wealth building. So all we're talking about here is putting that water wheel in the river that Chris was talking about and putting that, letting it fill up those buckets. Then we'll take those buckets and pay off some of the debts and then just recapture it. So this is what it looks like to pay off your car. Here's the math. 20 months, you're done in 35 months. Your policy has over $41,000 in it and a death benefit of 352. And yes, Andrew, opportunity cost. That is very, very important to think about, because every time we have a dollar in our hand, what can we do? We can take that dollar and spend it and it's gone forever. Or we can take that dollar and put it into this asset where it compounds and grows for the rest of our life. And yes, there's a little bit of drag at the beginning of that process, but my oldest policy is 16 years old, and I mean, it is just a cash growing monster. And so the more of those you have in life, the happier you're going to be later on down the road. But if I took that approach of I'm not going to take those first few years and take a step back to have something that grows for the rest of my life, then I would probably be like Thomas and everybody else sitting there just throwing cash at my debts. And I'd still be broke. I'd be throwing cash at my debts and still be broke.
The thing I always like about car loans is everybody's familiar with them, right? People have mortgages, but they're not familiar with how a mortgage works. They get a mortgage because they want the house, and then they just make the monthly payment. They very rarely read the fine print or the amortization schedule, but on car loans they do. And I think this is a really good way to look at it. It's like, listen, like, it's simple. All things remain exactly the same. You change where the money goes first, and then you do the same thing you're doing now. And in doing that, like, the payment's still $1,693. That's a nice car. And then down here you got, the interest that's paid to others. And I think this is just kind of like, why would you not do this, right? You can either give $5,205 to someone else, or you can give $3,122 to somebody else and keep $2,000. You recapture $2,082. Like, why would you not do that? Plus, the policy has 41 grand in cash value when you're done. That doesn't suck. Oh, and if something happened, like you got 352,000 in death benefit, like, the benefits just stack up and stack up. And sometimes I just, I go back to that thing I said earlier, like, here's your sign. Like, if you want to keep buying cars the way you are versus doing it the way we're teaching you, like, I don't quite understand, but sure, just keep giving money away. Cause like, that's all you're doing here is, if you do it the way everybody else is buying cars, you're just giving money to the banks. You're literally just, why don't you just set up a private foundation and just give money away to charities instead of giving it to the banks? Like, I'd much rather take and save $2,000 and give it to a good cause than give it to a bank. It's kind of like, I wouldn't want to give it to the government either. So you could do both. Take the $2,000 you save, put it into a private foundation or a charitable remainder trust, or donate it, get the tax write-off on the 2 grand, plus you just did good. That's just like, why are we donating money to banks when we don't have to?
So Chris, I know we're getting close, but I have one more thing, and I want to show everyone a cool, and this actually came from a call Marius and I was doing with a person that said, I've got a policy and they have a business and it's a landscaping business and they need to buy a mower. They need to buy a really expensive mower. And he said, I could take a loan for my policy at 5.3%, or I can go to the bank and they're willing to offer me 0% financing. What should I do? So let me just ask the group, what would you do? Would you take the 0% financing, or would you finance it from the policy at 5.3%? It's a little bit of a trick question. Well, Christian's saying policy just because I think he knows where I'm going with this. From the policy. Well, here's how the math works out. So the lawnmower was going to cost $12,825. His policy loan rate right now is 5.3, and the payment on the 0% option was $338.20. So if he were to take the policy loan, well, there's interest to pay, right? It's not 0%, it's 5.3. So he's going to have an interest cost of $1,143.67. Here's some other fun math. Is he really paying or is he paying 5.3% on his loan rate? No, he's paying 2.55% effectively, because if you look at the interest cost divided by the loan amount, it's 2.55%. So because it's a simple interest loan, because the every payment is going to reduce principal first and then calculate interest, set that to the side, this is a really efficient loan. But you're still probably wondering, why in the world is Craig saying do the policy loan and pay $1,143.67 of interest when he could have had zero? Well, there's more to the story, and I didn't tell you the last fact, which in talking to this person, they said, oh, by the way, the bank is charging me $1,000 just an upfront fee for this loan structure. So I'm like, well, then it isn't really 0%, is it? So we ran the math using the vault and said, well, here's your loan amount for your policy. And yes, you're going to pay $1,143.67 for your lawnmower. It's going to cost you $1,000 at the bank. So my question to him was, for the difference of $143.67, who do you want to hold this loan, you or the bank? If you have a bad day or a bad month and you miss your lawnmower payment, the bank's coming to get your lawnmower. If you miss a payment from your own system, who cares? So I asked the question, is that control and that flexibility worth $143.67 to you? He said, yes, I think I'm going to do my policy loan. Now it became a bigger question, because he said, now I have other lawnmowers I want to buy. Should I buy those from, the 0%, or should I overfund my policy? So that becomes another question, like, well, why wouldn't you want to overfund your policy and get as much of that money into your policy to build that compounding machine? So sometimes it's just a matter of talking through these things, because we're so trained and taught on how to run money, which this is not it. This is not what we're taught. So we want to get as much of his money into his personal banking system so that he can be the bank for his business when they buy more lawnmowers. And when they buy more lawnmowers, they can mow more yards. And when they mow more yards, they make more money. It's that water wheel that we're filling up our buckets again. So anyway, fun with math. Chris, I don't know if you have any other things you want to go over, but
I
that's
thought
what I
that
wanted
was
to touch
really
on.
cool. The lawnmower one I thought was just awesome. Now, folks, I've been putting the links, and Marius has been putting the links in the chat, because I got a lot of people asking, how do I get the vault? Like, how do I look at this? How do I do a demo? Well, I put the link over there. It's easy. It's just BYOB vault. And then I'm also putting over there a link where people, if someone wants to learn deep down how to use the vault, it's not complicated, but some people just like to walk through with someone. There's a training tomorrow at 7 p.m. I just put that up there as well. So the vault is easy. It's just BYOB vault. I'll put that over here. I've been kind of posting it throughout the day. And then the training is there. And hey, listen, if someone just wants to book a call because they got a unique situation, we've been trying to handle all these different questions in the chat and the Q&A as this has been going on. But here are all the resources. So you can book a call with one of our mentors right there. Okay, that's the link. Just click it. It'll bring up a calendar, pick a time, schedule a time with one of our mentors to go over your situation. All of our mentors are trained on the vault and are using the vault to solve your problems. But again, if you want to kind of become the expert in the vault and you want to use it yourself, you can just get it and then go to the training and learn how to use it, or just go on and figure it out. I don't care if you're buying lawnmowers, cars, tractor trailers, rental properties, your own home, or you just want to pay off debt. It works for all of those, and it's only getting better as we keep putting AI in it. There's already AI, but we're going to make AI a major piece of the vault. So stay tuned. And if you get in now, you're going to see all these evolutions. It's like any other software. Nobody bought QuickBooks 10 years ago and was like, I'm not going to buy QuickBooks today. I'm going to wait till they get all the features they have 10 years from now to join, right? You just take part in all those features as they come on. So that's how the vault is. So hopefully this is beneficial to you. Hopefully Tom or Thomas was on here, and hopefully we're able to solve your hater email or message on YouTube stating that the math doesn't math. We just math. How did we do this, Craig? How would we say that? We just mathed the math.
We showed you the math.
Yeah, math. I can't even say that. Like, my tongue doesn't go that way. But anyway, I hope you guys enjoyed that. With that being said, thanks everybody for joining us for this episode of the Wealth Webinar. We'll see you this afternoon, 4:30 for Ask Me Anything Happy Hour. Until then, have a great day.